Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about commercial property as a sector, whether you're investing in direct commercial property through ETFs online or through unlisted property trusts. It's all commercial property. And its sector has a few headwinds that it's facing. So, of course, all asset classes move in cycles. We know that. We know that investment returns are never linear. They're not going to move in a straight line fashion. And as such, investors must expect good and bad periods. And that's why patience and discipline is such a big contributor to an investor's success. I suspect commercial property investors' patience and discipline will be tested over the next year or so, as this asset class, as I said, is facing a lot of challenges. But as they say, every cloud has a silver lining, so it could create some good investment opportunities in the future as well. So let's talk about the challenges that the commercial property sector is facing. And really, commercial property as an asset class was probably the most adversely impacted by COVID lockdowns, especially with respect to retail and office sectors. If we think about retail, commercial landlords were asked to provide rent waivers, reductions during COVID lockdown periods, really to help those businesses through. And unfortunately, some of those businesses didn't survive, so that sector also had to then deal with much higher vacancy rates, which puts downward pressure on rental incomes. If we talk about the office sector, of course, employees were encouraged to work from home for long periods of time and actively discouraged from coming back into the city, particularly in Melbourne. This demonstrated to certainly employees and even to some extent employers that working from home was in fact possible. And now we've sort of arrived at a bit of a hybrid model for most employers where people work from the office 2 to 3 days a week, and some businesses starting to come back 5 days a week, although that would be the minority, I think. The consequence of that was that larger businesses that had very large footprints had the opportunity to reduce those footprints as people were working from home. In addition, businesses have been less inclined to commit to new lease agreements, just waiting out to see what happens with the market. The upshot is that tenant demand for both office and retail property is very low at the moment, probably the lowest it's been for some time. That said, things are changing, albeit slowly. More and more employers are demanding people come back into the office. In fact, NAB is leading that charge, I think, out of all the large corporates, where they've demanded that senior managers work from the office 5 days a week. I expect other corporates to follow and employees to want to come back in the office, particularly if the unemployment rate increases. It's circa 3.7% at the moment. If it gets to 5%, I think employees will also be motivated to come back in the office as well to make sure their job is secure and to pursue whatever career progression might be available to them that is more readily available, I think, if they attend the office than if they're sitting in their lounge room at home. So, of course, demand is unnaturally low as a result of those COVID lockdowns, but that's not the real problem. The real problem are cap rates. Cap rates is an abbreviated term for capitalisation rate, and it really is the key component in valuing commercial property. Unlike residential property, the value of a commercial property is highly dependent on the rental income that property generates, whereas residential property is more driven by the underlying land value. Therefore, to value a commercial property, you must apply its cap rate to its income. And the cap rate really is the amount of return that investors demand from investing in that property. So, for example, if investors demand, say, a 5% income return from commercial property, and a particular property is generating, say, $100,000 of income, net operating income, then its technical value is $2 million, which is really just $100,000 divided by 5% equals $2 million, and that's how you tend to value commercial property. Cap rates are influenced by several factors, but the main influencer really is the level of incomes offered by alternative investments. because I'm looking to invest my money to generate income and I want a consistent and reliable level of income. I can invest it in commercial property, or I can invest it in bonds or other those sort of style of investments, and they're the alternatives. So, for example, if term deposits, which obviously are risk-free, are paying, say, 4.5%, then you'd probably want 6.5% or more if you're going to invest in commercial property. If you're going to take some risk, you want to be rewarded for that risk. And that's why when interest rates were low, cap rates were pulled down, because investors were on the search for income and they were prepared to take slightly less income from commercial property than they historically would have been, because where else are they going to put their money? If they put their money in the bank, they wouldn't have earned any interest. And last year, cap rates in Melbourne and Sydney typically ranged between 4.25 and maybe 5.5% for good quality office property. So they're quite low. However, the world has changed a lot since then, and there's a lot more options available to investors that are going to pay a high income for taking low risk. So, for example, I can invest in a investment grade bond issued by one of the large banks in Australia, so some of the safest banks and institutions really in the world, and I can earn circa 6% without taking very much risk. So again, commercial property investors are therefore thinking, why would I want to accept a 5% yield on a commercial property when I can get 6% and take a whole lot less risk? And as such, commercial cap rates need to increase. So using the above example where we had a property generating $100,000 of income on a 5% cap rate equals $2 million. If we assume cap rates need to rise to let's say 7%, that same commercial property would only be worth $1.4 million, a 30% reduction, because I'm dividing $100,000 by 7% instead of 5%. So that's the big risk that's facing commercial property investors at the moment, is an increase in cap rates, and arguably, or at least technically, an inevitable increase in cap rates. Now the question is, have commercial property values fallen? Well, the answer is not really, or at least not yet. There's been a little bit of a Mexican standoff between potential buyers and sellers. So I've heard that some really large super funds have tried to sell assets at their book value, but they've only received offers 30% below their book value. Now, those super funds don't want to sell those assets at 30% below because they're going to record a loss. Whereas the buyers, they're saying, that's fine, but I don't want to pay 22 or 2021 prices. I want to pay the prices based on today's cap rates. And as I said, there's been a Mexican standoff, and ultimately those sellers have pulled those properties off the market because they're not getting bids at the level that they're comfortable with. Now, this all may come home to roost because super funds must revalue their commercial assets, and in fact all unlisted assets, at the end of the financial year, so really in only just a few weeks' time. Technically, they should record a reduction in value, but whether that transpires, I'm uncertain, as I've talked about the lack of transparency and accountability in the industry super fund sector in the past. So I'm most interested in what happens here, and of course I'll be talking about it right here on this podcast to see how they go about revaluing some of these assets. Of course, unlisted real estate investment trusts need to or are facing the same problem in terms of revaluing, and most of those revalue at 30 June as well, so it's not just exclusive to superannuation funds. Now, comparing commercial property at the moment with, say, investment-grade corporate debt, corporate bonds, is, of course, a reasonable comparison because realistically, that's where I can put my money, at least today anyway. And, of course, I'm not going to put it in commercial property if I can earn 6% without taking much risk. However, if you ask me, will banks continue to pay 6% on their bonds? My answer would be no. My response would be that the banks have had to pay 6% on their bonds because they had a lot of debt to refinance, a lot of debt to repay that the RBA lent them through the COVID period. So they had to pay a little bit more than they otherwise would on those commercial bonds. I think those commercial bond yields will come down, and as a result, there'll be less pressure on commercial property cap rates. In addition, the RBA has pushed the cash rate very high, and by its own admission, it thinks or estimates that the neutral cash rate is somewhere close to 2.5%. At the moment, it's 3.85%. So it's very clear in my mind that I think they've pushed the cash rate high enough to deal with the inflationary pressures, and you certainly see some anecdotal signs that consumers are responding to that. Now, it might take a little bit longer for those interest rate increases to filter through to the economy because of those very low fixed rate loans that are coming to maturity. But once they do come to maturity, I think a cash rate of 3.85% will well and truly do the work. Now, whether the RBA has the patience and whether they've got enough fortitude to kind of ignore the criticism of not doing enough because they didn't do enough previously and they feel like they need to go over and above, I'm not sure. So maybe the RBA will keep pushing the rate up and up, but it just means they'll have to cut it more aggressively when these higher interest rates do bite. But the point is that cap rates might have to technically rise today because of where interest rates are and because of where bond yields are. But whether those interest rates and bond yields will be at the same setting in, say, 12 months' time is a completely different question. I don't think they will. I think they'll be lower. And so whilst we might see a temporary reduction, a technical value of commercial property might reduce as at 30 June, I don't know if that technical valuation level will persist for a long period of time. I think a lot will change. Now, what do you do? If you're invested in commercial property at the moment, what do you do? Well, the fact is that no one can really predict which asset class will perform the best or worst over the short run, say over the next 1 to 2 years. In fact, no one in the world has developed a reliable method for predicting those short-term returns. Therefore, investors should spread their wealth across various different asset classes, knowing that they're going to perform differently at different times, and the hope is that at a portfolio level, it smooths your overall return. So you're certainly not going to hear this bad news and go, that's it, I'm going to sell my commercial property investments, because the whole point of having them is to have some of that diversification, and in doing so, you're acknowledging that some asset classes are going to perform differently at different times. It's really about making sure that the investment that you've made, is it really going to work? So if you've invested in commercial property, you've either done that either directly, a direct commercial property, you've done it through an unlisted property trust, and there's a lot of them around, or a listed property trust, one that's traded on the ASX. So if you've got a direct commercial property, it's really about considering whether it has the attributes to drive good quality capital growth and a high level of income. And of course, hopefully you would have considered that, but before you actually purchase the property, hopefully you would have got some specific advice about that. So if you're quite comfortable with the quality of the asset, then all you need to do is shut your eyes and not really look at any technical valuations. Of course, you're not going to technically revalue the property anyway, probably, so you don't need to worry so much about this. If you've invested in unlisted property trusts, the answer is you must absolutely ensure you've got a good manager in place that's going to really look after the asset. You want, firstly, a really experienced and stable team, the same people with the same level of experience that are running those properties, that are looking after those properties, that are maximising their value. Commercial properties always moved in cycles, so what's happening today is nothing new. And if anyone's got more than a couple of decades of experience, they would have been through it all before, and they'll know how to navigate these really tight markets. The second thing is that you want that manager to be doing everything possible to make your property look as attractive as possible to the albeit smaller rental pool. So you want to make sure that your building or your property is offering something different than the property next door or down the road. And lastly, you want to make sure that your manager has some skin in the game. See, my concern with really large institutional real estate investment trusts, the listed ones, is that there's no skin in the game. They'll hire acquisition managers, they'll go and buy property. By the time that property, is ready to deliver returns, that whoever bought it, the personnel, they've moved on to their next employer. They don't really care. Whereas if you've got a smaller investment manager, they're typically owned and operated by a small group of individuals, and they depend on their good reputations to attract future investment dollars. So there's a lot of skin in the game for them to make sure that that asset, that investment's going to work really well. So it really comes down to the manager and the skill and experience of the manager. If you've got a skillful and experienced manager in place, then you should be fine to ride out this next possibly tumultuous period. If you invest in listed REITs, listed real estate investment trusts, the first thing I would say is stick to the index. According to data by S&P Dow Jones, between 75 and 80% of actively managed real estate investment trusts fail to beat the index over periods of 10 to 15 years. So don't go active, go index. I don't really like the Australian index because it has too much exposure to retail property on a look-through basis. Therefore, I prefer to stick to global REITs. And there's, because they've got less exposure to retail property, and there's two that I like. One is an ETF, Van Eck ETF with the ticker code REIT. And Vanguard has a managed fund that's a global, it comes in either hedged or unhedged version, but it's only in managed fund format. I've got the link to both those investments in the show notes. The good or perhaps bad news is that listed index REITs arguably already affect the impacts of higher cap rates. Vanguard's managed fund has fallen 25% since the start of 2022 and Van Eck about 30%. So therefore, arguably all the bad news is already reflected in current prices and maybe they make good investments today. I'm not totally sure of that, but certainly the downside has already evaporated, or at least largely evaporated. So to sum up, commercial property investors should prepare for a bit of bad news over the next 12-ish or so months. However, if their investment is fundamentally sound, the best thing to do is exercise patience and discipline. Relax about it. It's a long-term investment. If it's a good quality investment, it's going to work. It's going to generate great returns. It's really just about making sure that you do have the right investment and the right exposure. Okay, that's it for me for this week. Until next week, bye for now.